Here's the 8 principles. I'm going to run down all 8 of them really quickly, and then we'll come back and take them kind of one by one. So in no certain order, I've sort of reordered these for my own purposes, but in no certain order, the business has to be simple and predictable, a dominant market position, limit exposure to extrinsic risk that we can't control, free cash flow generative, large barriers to entry, excellent management and good governance, high return on capital, and a strong balance sheet that doesn't need outside capital. So those are the eight things. Now, when we talk about sort of our checklist, what I look at is the principal things that we've been talking about on this podcast, which is from Charlie Munger's checklist. So to go back to Charlie for a second, in comparison, he basically says 4 things. Number 1, you have to be capable of understanding the business. Number 2, it has to have a durable competitive advantage that's intrinsic to the company. Number 3, it has to have management with integrity and talent. And number 4, you have to be able to buy it on sale. You need a margin of safety. Now, Bill's checklist doesn't deal with the first thing that Charlie said. It doesn't deal with being capable of understanding the business. Well, he does slightly in the first principle, which is the business has to be simple and predictable. So even one of the smartest guys on the planet, besides Charlie and Warren, requires that the businesses be simple and predictable, because when he got off into businesses that were a little harder to understand, that's where the errors started to creep in. Not necessarily that he didn't understand them or he wasn't capable of understanding them, but that they weren't simple and they weren't predictable. And the result is, even though you understand them, it doesn't mean they're going to keep doing what they've been doing. So understanding the business, that's kind of goes without saying on Bill's checklist. So we're going to sort of put that first thing aside. But you have to remember that for a professional like Ackman, that's a no-brainer, right? You obviously have to understand the business. But for amateurs, oh man, that's where we fall off the wagon all the time, is we fail to realize how shallow we have looked at this business. We don't realize how deep we have to go. So let's not put that one away permanently. Let's just remember that Bill's a professional and doesn't need to remind himself. He better understand the business. Now, the second one that Charlie talks about is effectively what we call Moat. That is, the business has to have some kind of protective moat around it to keep competition away. Now, what we talk about when we start to break out the understanding of the business is we talk about the meaning of the business and the moat of the business. And these two things could kind of be combined under Ackman's view. So I'll look at it both ways. So for example, under what we would consider to be the meaning of the business, understanding the business would be that it's simple and predictable, that you know that it has a dominant market position and it has limited exposure to extrinsic risk. So these are 3 of Bill's 8 elements. So let's talk about each one of them. Simple and predictable means that the business is something that, one way to think about it is something that an idiot could run. Once it's got itself going, you don't want an idiot to run it, but Warren once said, you want it so simple that an idiot could run it because someday an idiot will, and you want the business to survive the idiot. So you can't have a business that's super complicated, or you end up with a real difficult investment decision down the road if this business starts to falter. Then you don't know, will it be recovering or will it require genius to get it back on track? So simple and predictable for me is something like Chipotle burritos. You guys know that from listening to this thing. All right, next thing, dominant market position. That means that this company has already done something that protects it from competition. It is already has some sort of moat around it that lets it dominate its competition. That means it controls the majority of this market, or it's a very dominant piece of this market. Majority control is very rare out there. Usually there's 2 or 3 companies that have the total market control, but dominance can be 20, 30% of the market, 40% of the market. So when you think about colas and you think about a Coca-Cola and a Pepsi, there's a lot of other colas out there, a lot of other kinds of drinks, but those are the dominant guys in that industry. And that's there because they have some sort of a moat. So dominant market position is what we'd put in trying to understand the business properly. We need to know how well that stacks up. And a couple of ways you can look at it. Dominant market position can be the biggest revenues in the market. It could be, although we don't lean heavily on that, we could say, yeah, it's dominant. And then we want to look, of course, at other things in terms of understanding how good a business it is. And then finally, limited exposure to extrinsic risk that we can't control. So an extrinsic risk that we can't control is something like a commodity business where China decides to just dump steel into the world market. It's an extrinsic risk that they might do that, and we have no control over that. If they decide to do it, they can crush steel prices. I invested in a company a while back where I really, really got burned, and it was a company that was the dominant producer of zinc in the United States and had by far the best cost position. So it had a price moat, and that price moat didn't matter when a big commodity buyer and a holder of commodities like copper and gold and silver, a great big one, just decided in order to shore up its cash position to dump zinc on the market. And it dropped the price of zinc from $1.10 to about 60 cents, all during the time this company was having other problems. And that extrinsic risk that we couldn't control ended up shoving that company into a Chapter 11 bankruptcy. So extrinsic risk, that could also be legislative risk. If you're a coal company and the legislatures are they're going to make huge barriers to you to produce your coal, then you have extrinsic risk. You can't control it. You may not want to be in that kind of a business. So those three things, simple and predictable, dominant market position, limited exposure to extrinsic risk, those are part of understanding the business. Are you capable of understanding this business? Do you know where it sits in its industry? Do you know that it can avoid extrinsic risk to the degree that are reasonable? And is it simple and predictable? Now, we go on to the next thing that Bill asks us to look at, which is that it's free cash flow generative. And we consider this to be a major sign of a big moat business. Big moat business, very, very good at producing cash flow. And that means that it's producing cash flow, in my view, with at least 75% of earnings and ideally at 100% of earnings or more. So that virtually all of the money coming through the company is not sort of artificial earnings. It's not sort of, we have earnings on our income statement, but we don't have any cash. It is actually a cash generating business. It doesn't require a lot of money to just keep it going. So free cash flow generative. That's one of the things I loved about Chipotle. It's just a cash machine, produces a lot of cash. They're able to build their business entirely out of their free cash, never have to borrow money to do it. The second thing that Bill asks us about, or that we put into the moat, this is his fifth principle, is large barriers to entry. This is a classic definition of moat, that the company has taken on a niche position and there are large barriers to entry. So what are those large barriers to entry? Well, let's think about some of them. One really big one is that there are no other businesses in this business because of government regulation. So this is what utilities experience as a kind of a moat, which is what we call a toll bridge moat. Utilities are basically set up to have quasi-governmental control of their market. And so very unusual. One of those utilities has real problems, like Pacific Gas and Electric out in California is an amazing experience of a utility going bankrupt a couple of times, which has more to do with the legislature of California and their wishful thinking about what they can regulate in terms of the costs of energy than anything else, than bad management, although certainly bad management is part of it. So large barriers to entry. Those are our typical moats. So let's go down a couple more of them. A switching moat makes it very difficult for companies to come in and compete with me if I've locked up my client totally by having backroom control. This would be what Infosys and IBM and Microsoft have. Large barriers to entry. Apple has a similar thing, switching moat. Very difficult to exit their ecosystem without a complete big deal change of software and the whole deal. You guys, if you enjoyed this video and you feel it was valuable in teaching you more about how to invest, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen. We got a free gift for you. Thanks again for watching.